Open any brokerage app, and your eyes are immediately drawn to the highest numbers on the screen. 100%, 200%, 500% returns. The temptation to blindly chase a massive return on investment is the easiest trap for an amateur to fall into. But evaluating an asset on that raw, simple percentage is deceptive. It strips away the context of time. A 100% gain over 50 years is a stagnant investment, and looking at the raw endpoint ignores the mathematical necessity of compounding. This chart shows exactly how that illusion breaks down. On the left, a volatile stock might boast a high simple average return, but on the right, we see its compounded annual growth rate, or CAGR. This metric smooths out the wild swings to show you the actual year-over-year growth rate required to get from your starting balance to your ending balance. Yet, even a perfectly accurate CAGR is functionally meaningless in isolation. It tells you what happened, but it hides the invisible cost required to achieve it, the possibility of total ruin. To understand that cost, we have to move past the layman's definition of risk. In finance, risk is not just the danger of losing money, it is volatility, the statistical measure of how wildly an asset's price swings away from its expected path. This leads us to the immutable law of finance. To attain higher returns, you must mathematically accept a wider, more violent range of potential outcomes, which presents a large problem. If risk is inherently tied to unpredictable chaos, how do analysts ever manage to measure it, let alone tame it? Professional investing treats risk not as a danger to be avoided, but as a variable to be precisely priced. To price that chaos, you first have to divide it into two buckets. The first is systematic risk. These are the inescapable macroeconomic forces that hit the entire market at once, things like sudden interest rate hikes, global wars, or hyperinflation. Contrast that with unsystematic risk. These are localized, company-specific disasters. A CEO gets caught embezzling funds, a factory burns down, or a single corporate bond defaults. Here is the mathematical loophole. Unsystematic risk can be almost entirely neutralized. If you hold a properly diversified portfolio of 30 different companies in 30 different sectors, one factory burning down barely registers on your overall balance sheet. Because this risk can be neutralized for free by any investor with a diverse portfolio, the market offers no risk premium for it. You are only compensated for enduring systematic risk, the volatility that no amount of diversification can erase. This animation shows the foundational tool used to measure that unavoidable chaos, standard deviation. A tall, tight curve means the asset's price rarely strays from its historical average. But as that curve flattens out into a wide, shallow distribution, it proves the asset experiences massive, unpredictable price swings. This graph shows another layer of measurement called beta. The smooth, flat baseline represents the overall market index, given a beta of exactly 1. The erratic, spiked line jumping above and below it represents a stock with a beta greater than 1, proving it is far more sensitive and volatile than the market itself. Here, the shaded red zone shows a metric called value at risk, or VAR. It calculates a strict threshold, telling an investor the maximum probable loss they might suffer within a specific time frame, based on historical data. By utilizing standard deviation, beta, and VAR, the financial industry takes the raw, unpredictable emotion of human fear and transforms it into cold, calculable probabilities. Measuring risk is only half the equation. To actually make a decision, that risk must be mathematically weighed against the expected payout to find the risk-adjusted return. Analysts use formulas like the Sharpe ratio and Jensen's alpha as their ultimate polygraph tests. These equations measure if a portfolio's gains were high enough to justify the volatility experienced, or if those returns were simply the byproduct of a reckless, high-risk strategy. Armed with these precise formulas, the stock market appears to be a perfectly rational, entirely solvable mathematical game. So, if the math to manage risk is perfect, why do brilliant analysts and Nobel laureates still manage to lose billions of dollars? The answer lies in behavioral finance. Those perfect mathematical models all share one fatal flaw. They assume that humans act as rational, emotionless calculators. We aren't. Take the concept of loss aversion. Psychological studies show that the pain of losing $100 is felt twice as intensely as the joy of gaining $100. When markets crash, investors don't consult their Sharpe ratios. They freeze, panic, and sell at the exact bottom. Then there's herd mentality and anchoring. Investors will abandon their spreadsheets to blindly follow a crowd off a cliff, or stubbornly hold on to a dying stock because they are emotionally anchored to the price they paid for it. As the economist John Maynard Keynes famously noted, it is better for reputations to fail conventionally than to succeed unconventionally. The moment panic sets in, psychological biases override risk-adjusted formulas every single time. Benjamin Graham, the father of value investing, understood this flaw completely. He created an allegory called Mr. Market. He suggested you view market volatility not as a formula, but as an emotional, manic-depressive business partner who shouts completely different prices at you every single day. You cannot predict Mr. Market's wild mood swings, and you certainly can't predict your own panic when things go wrong. Because of that, your ultimate defense isn't a complex equation. It is the margin of safety. This chart compares the concept directly. The tall column is the carefully calculated intrinsic value of a business. The much shorter column is its current market price. The gap between them is the margin of safety. It is the strict discipline of only buying an asset when its price is significantly below what it is actually worth. That deliberate, built-in buffer provides a cushion against error. It protects you from bad mathematical assumptions, unforeseen systemic disasters, and, most importantly, your own psychological flaws. Investment mastery unites mathematical rigor with the psychological discipline to ignore the crowd.